Instacart, Klaviyo, and Arm all IPO'd in the past week. What do you think the last week means for the greater technology industry?
I don't think that this was the great reopening that we all were hoping for. I think it's important to understand the dynamics of bank-led traditional IPOs in America. And the best way to understand them is to contrast and compare to how that same company would go public in Europe or Asia, because it'll explain what happened. And I think, unfortunately, what has happened is not good for the market. So typically what happens is when you construct an IPO, you're selling 15 to 20% of the company. And when you do that, you go and you call hedge funds and you call these mutual funds, what are called long onlys, right? Meaning they don't short, they just go long, these big mutual fund companies. And you try to find a handful of people to anchor the IPO. So they take a huge piece of that 15 to 20%. And in Europe and Asia, the securities law says that when you get such a big allocation, you have to hold it for 6 months, which means you're treated exactly the same as the employees, who are typically locked up in an IPO for at least 6 months. And so what happens is these firms do all kinds of diligence. And when they buy something, it's because they really believe in it. And then they go long it for, what is at least half a year. So it's a non-trivial amount of time. So that's what happens in Europe and Asia. 15 to 20% of the company is sold, a handful of people anchor, and you're locked up for 6 months. Now you need to look at how American IPOs are done, which is why people have experimented with direct listings. We've experimented with SPACs. It's because the fundamental architecture of IPOs are broken. They're set up in a dynamic where it's a heads I win, tails you lose situation for the bankers that run the IPO. Now, what happened in these 3 IPOs? Number one, it was less than 10% of the float. So highly concentrated, small amount of the company was made available for sale. Number two, there really weren't anchors. What happened was the allocation of that less than 10% was smeared across 50 or 60 different organizations. And then number three, there was no lockup, which meant that people could sell right away. And so what you saw with all of these companies was the exact same dynamic, which was it opened because there was such a small amount of supply, it traded up. And the minute that retail, which typically tends to be late to the game because they don't have access to these things, right? When they started buying, what was unique this time around is all of the mutual funds just dumped everything. And the hedge funds were like, well, we don't have a real allocation. Our friend said in the group chat, he got a $5 or $10 million allocation in these IPOs. These are $20 and $30 billion hedge funds. $5 and $10 million allocations don't move the needle. So the hedge funds sold right away and got on the sidelines and said, I don't care about this. The long onlys bought just enough to make the stock go up because of such a small supply. Then when retail stepped in, they just dumped it all. And so unfortunately, what's happened is all 3 IPOs within a few days have breached their issue price. Now, they're at the same issue price, maybe slightly higher, but that is an unsuccessful dynamic. What could have been different? The banks could have forced these companies to sell up to 20%. The banks could have found a few anchor buyers. The banks could have created a lockup structure for these anchor buyers. They did none of it. And so the result is a lot of downward pressure in a moment where the overhang of rates have come back and are forcing all of us to realize, and we'll talk about it in a second, that these rates are going to be higher for longer, which completely changes how you value these tech companies. So net, very poor IPO construction by the banks, and the grand reopening was a grand closing, I think.
Okay, so just to put some numbers on that, Instacart's float was 6.7% and Klaviyo's float 7.6%. Arm's float almost hit the 10%, 9.4%, but certainly less than the 20% that you would expect. So then I guess the follow-up question here at Sachs is, why did these companies go out, and will we see the other big ones go out, the Stripes and some of the other backed up inventory? What's the back channel in our industry about the viability of other IPOs? Is this going to push a lot more people out to get liquidity, even at discounted prices, even with the headwinds that Chamath points out? Or is this going to have a chilling effect and people are going to say, you know what, let me wait till 2025.
So I think they went out because investors and others need liquidity. And there's no point holding on and waiting for a valuation that's never going to come back. I mean, so you take Instacart, for example, their last private round was at $39 billion. What's the market cap now? Around 10? 9. So it's great that they got out. I think
and
that
no,
is...
it's at 8 today.
It's at 8. I mean, look, it's sort of a green shoot that they got out, but we're never going back to the valuation levels that we had a couple of years ago during a giant ZERP-created asset bubble. So I just think there's no reason to wait. And you look at SoftBank, they needed the liquidity from the ARM IPO.
Yeah.
So I think that's why these companies are going out we're kind of getting back to business as usual. Just to broaden out the question a little bit, what I think is interesting is that for the past year or so, we've been in a software recession. It really started in the first half of 2022. The markets cratered, especially for growth stocks. There's a huge correction in valuations that happened in especially the first half of 2022. But then about a year ago, so starting in mid-22 and continuing through Q2 of this year, you saw a reduction in growth forecasts. Everybody started forecasting down. There wasn't a single board meeting that I was in private companies that wasn't missing their numbers and reforecasting down. And you saw it in the public companies as well. I think Jeremy Ball's Substack showed that the average growth forecast for SaaS companies for next 12 months have been cut roughly in half. So for the last year and a half, we've been in a software recession. You could say a B2B recession. We saw companies like Meta, Google, and so on cut thousands of jobs.
Tens of thousands
of jobs, get much more efficient. Each. That meant they were buying a lot less software on a per seat basis. So I think we've been through, call it a B2B or enterprise recession. But the thing that's held up stronger than I think people might have expected over the past year has been the consumer. Consumer spending has kept the economy afloat. So the B2C part of the economy has been strong, whereas B2B has been very weak. What I wonder about next is whether that's going to flip. I wonder if the consumer is on their last legs here. You see credit card debt is at an all-time high. Interest payments on credit card debt, all-time high. Mortgages, the rate now is approaching 8%. So no one can afford to sell their house, which has a 3% mortgage, and then buy a new one at 8%. So real estate transactions have cratered. The commercial real estate industry is, on its last legs. I think they're starting to throw the keys back to the bank and start forfeiting buildings because they can't refi at an attractive rate. So I just wonder if the consumer now is about to go through the type of pain and restructuring of their personal balance sheets the way that the enterprise segment of the economy did over the past year.
Friedberg, your thoughts on what we're seeing here in terms of the IPO window, companies getting out, and the impact that'll have maybe on how limited partners look at venture funds. That's been frozen for 18 months. Limited partners, and I'm raising a fund right now publicly under 506C, so I can talk about it. And it's going great, but man, it's a lot of meetings. And I'd say 2/3 of the meetings I'm having, people are saying, we're not adding managers, we're cutting managers, and we're cutting commitments to managers. But we'd love to meet, just to start the relationship, So what do you think this means overall for the limited partner GPs and the startup market? Start of a turnaround or maybe just sideways for more?
I guess we should just put the volume in context. If you look at this slide, this is from Ernst & Young showing the IPO activity by year. And this was through June 30th. So if you assume kind of a steady state, you probably are going to come in at a volume that's less than 22 and perhaps even less than going back all the way to 2019 with less than 1,200 IPOs during the year compared to the peak of 2,400, which happened in 2021. And if you go to the next slide and just look at the total dollar volume raised, so the IPO proceeds thus far through June 30th of this year is just around $60 billion. Compare that to a total of about $180 billion all of last year, $450 billion in 2021. And the IPOs we're talking about today, Instacart, Klaviyo, ARM, in total raised about $5.5 billion. So, that kind of doesn't have a huge consequence on this dollar volume for the year. And then if you look at what's in the pipeline right now in terms of what's publicly filed as S1s, there's basically nothing right now.